The puppet masters of Silicon Valley, the venture capitalist who can turn a college dorm room idea into next billion-dollar unicorn. But here is the thing, until Scott Cooper pulled back the curtain, this world was as opaque as black box. Cooper doesn't explain venture capital. He performs surgery on it, dissecting every component with surgical precision. Think of this book as your backstage pass to the world where handshake deals can be worth hundreds of millions and where the difference between participating and non participating liquidation preferences can make or break founders' financial future. Now, here is what makes this particularly relevant today. Global venture capital funding reached $113 billion in Q1 2025, marking a 17% gain quarter over quarter, with startups attracting $91.5 billion according to PitchBook, the second highest quarterly investment in the last decade. We are living through what many calling the resonance in venture capital, yet the fundamental mechanics that Cooper describes remain unchanged. Let's start with fascinating historical parallels that Scott draws. He traces venture capital all the way back to Queen Isabel funding Christopher Columbus' voyage to the New World. Think about it. She essentially the world's first venture capitalist, providing risk capital for an unproven concept with massive upside potential. The risk reward calculation hasn't changed much, has it? Fast forward to 1990s dot-com boom, the Scott paints a vivid picture about Silicon Valley during its most euphoric period. Companies like Netscape and Amazon weren't just business. They were prophets of digital revolution. But here is the brutal lesson Scott emphasizes. Timing is everything. Many companies failed not because their ideas were bad, but because they were simply ahead of their time. The market wasn't ready for their vision. This brings us to one of the most significant steps Scott identifies, the democratization of effect Y contributor. Before YC, the venture capital world was like an exclusive club with an unwritten dress code and secret handshakes. Y Contributor changed all that by essentially publishing the playbook. Suddenly, entrepreneurs from anywhere could understand how venture capital worked, how to raise it, and most importantly, how to negotiate from the position of strength. Now, here is where it gets really interesting. Most people think venture capitalists are investing their own money. They are not. They're essentially money managers for what Scott calls limited partner or LPs. These are university endowments, pension funds, sovereign wealth funds, and family offices that provide billions of dollars to VCs to invest. Imagine you are the Harvard endowment manager. You got billions to invest, and you are looking for what Scott calls alpha returns the beat the market. You can't just put everything in index funds. You need diversification, and venture capital offers tantalizing possibility of those home run returns that can make or break your performance members. But here is a catch, and this is crucial for entrepreneurs to understand. Limited partners or LPs want their money back. They're not patient forever. This is what creates Scott describes as the fundamental tension in the VC world. As the funds age, the pressure to return capital to limited partners intensifies, which directly impacts how venture capitalists think about exits and liquidity events. Let's talk about something that might seem boring but is absolutely crucial in corporate structure. Scott makes a compelling case for why almost every startup structured be as a C corporation. Now, you might be thinking, what does this matter and why does this matter? Here's why. It's like choosing the right foundation for skyscraper. Get it wrong and everything else become exponentially more difficult. The C corp structure isn't just about taxes. Though that is important, it's about creating a framework that can accommodate the complex equity arrangements through venture capital demands. When you are granting stock options to employees, issuing preferred shares to investors, and navigating multiple rounds of financing, you need that structure that can handle the complexity without collapsing under its own weight. Thank you very much for watching this.